Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
All right.
Hey,
Tuesday, doing a Monday morning on a Tuesday. So I got to tell you something. At least we're getting it done. I just got back from 12 days on a boat trip. So
Nice.
all of you that are sitting with bated breath, waiting for the Monday Mortgage Minute to come out, sorry for the delay, but you're getting it today nonetheless. How do you like that?
There we go, man. At least we're sticking with it.
Hey,
So,
I'll tell you what. I've been getting a ton of calls with interest rates starting to improve about refinances.
sure.
But a lot of folks are like, you know what, Bruce, I got a 3.5% 30-year fixed rate on my house. I don't want to refi. I don't want to refi. I just want to get a HELOC and consolidate the debt. So I want to talk about which is better, refinancing or a HELOC.
All right, sounds good.
So ask me any questions you want.
I guess the first question is, what would you need to know from me to be able to help me determine which way is going to be better?
What do you need the money for and how much do you need? How much do you owe on the first mortgage and what interest rate's it at? And how long have you been paying on it? Because if you've been paying on a 3.5% 30-year fixed rate for 10 years, you've been into it a long time. If you've been paying on it for 2 years, you haven't been paying on it for a long time. It can make a difference. I had a client the other day, they only owed $85,000 on the first. They wanted $160,000 on the second. Their credit score was in the low 700s. It was going to be about 11% interest rate on a HELOC. It made no sense for them to have twice as much money on a HELOC just to save the interest rate on the primary mortgage. And when you balance it out, and the only way for me to really know is not to guess. The only way to know, put the numbers together. The numbers read the tea leaves. So I'm getting a lot of calls, and I don't like taking people out of a low interest rate. I don't want to do that. I want you to have a low interest rate, but you have to realize it's not the interest rate. It's the rate of return. It's the total cost of money. So I had a client, her name was Judy. She had a 3.5% 30-year fixed rate. She owed $300,000 on her house.
All right.
She was only paying $1,500 a month, $1,500 a month for this really low rate. But she had $1,200 a month in car payments, 2 cars, $1,500 a month in other debt, and she needed $25,000 to $30,000 to fix her house up, which on the HELOC just for the 25 or 30 was going to be about $300 a month. So when I added up everything, she'd be paying $5,000 a month. I looked at it and I said, Judy, I could consolidate everything. I don't want to do the cars in a HELOC. It doesn't make sense. But if I refinanced it, I would put everything into it, give you your 25 or 30 grand and have one payment. So I worked it out and I was able to get her total payments from $5,000 to $2,500. Now, she finally acquiesced and said, all right, I'm going to do it. We went to closing. We closed. I asked her, are you excited about this? She goes, I love saving $2,500, Bruce. My problem and the concern that I had is I did not want to spread my vehicles over a 30-year period of time. And I said, I don't blame you at all. I don't blame you. But I just
you're going to replace them in 4 or 5, 6 years, you know.
Correct.
Right.
So here's the thing. So I said, Judy, I saved you $2,500 a month. If you put that $2,500 a month towards your new mortgage, you would be debt-free in 8.3 years, just a little longer than you're going to keep these cars.
Wow.
Okay. 8.3 years, no debt, no mortgage, no cars, no credit card, nothing. She said, I love it, but I really like to save a little bit of money. So I said, how about put $2,000 extra toward the mortgage? You saved $500 a month. That was one of your car payments, $500 a month. Now your house is paid off in 10 years. and she's retiring in 10 years, it was the perfect scenario.
There you
So
go.
the answer to the question is everyone is different. Not everybody fits into the same category. So we have to look at these situations and really customize it to that client's best needs. And a lot of lenders, the first thing they're going to try to do is flip the client to a refi over a HELOC.
Sure.
And they do that because there's no money for a lender to be made on a HELOC.
Oh, well, I didn't know that. Okay.
The HELOCs for us are so that we can service our clientele. That's
Got
what they're for. So I can keep that clientele and they know they can always count on me for any type of mortgage services.
The Judy there, I would add a little bit to that if I were her. Being a guy that always likes to have no debt on everything that I own, especially depreciating assets, that I just said, take that extra $500 I saved you, put it away every month. And when you need a new car, pay cash.
That's another option. And, these are all things that people need to look at and decide that this might be better. But you're right. $500 a month for 60 months.
Yeah, that's a car.
There's a car.
There's a car. So, yeah.
So HELOCs are easy. They're cheaper. But
so let's talk about HELOC versus a home equity loan, right?
Okay.
Because other than refi, let's say I want to keep my 3.5% rate in place, right? But I need some cash for whatever it is. Let's talk about HELOC, which is a home equity line of credit, right?
Correct.
Versus a home equity loan, which is a one-time loan, right?
Right. We call those HE loans
bit.
too. Those are called HE loans. So it's just a fixed rate second mortgage. That's all it is.
Right.
A HELOC is an adjustable rate second mortgage tied to prime. Now, the bank will have a margin or a spread over prime, and that margin or spread remains constant over the life of your loan, provided you have not made any significant changes to your credit. And in some HE loans, if you pay it off and then want to use it again, the terms are reset. Now, since we're anticipating some rate cuts in the future, that could be good for HELOCs or HE loans. But remember, it's also going to be good for refinances. So if interest rates do tend to drop based on Fed cuts, and we're expecting 3 Fed cuts this year, will it happen? No one knows. But I think September's our first. I think it's going to be a 0.5 point cut. And I think there could be 3 more before the end of the year, or 2 more after that.
2 more after that, right? That's, you think that's before the end of the year?
That's what they're saying, 2025. Wow.
Yeah, that's pretty aggressive considering
that's aggressive.
Like what, 2 years now, right?
I think it's the only way he's going to save his job, and I don't even think that's going to happen. But you've got Bowman and Keller are all after the Fed chairman to start dropping rates. So I think it's going to happen. The central banks in Europe are after us to drop rates. We are clogging up the system, and I think that we can get things back in action, and it will offset some of the tariffs as well and help the economy really thrive. What they're concerned about is if we get the economy to thrive too much, could that negatively affect inflation and we start having inflation again, which then turns everything upside down, and then interest rates go back up again.
I understand that. It seems to me like the Fed over the last decade has been very slow to make decisions, right? And I think they left the 2%, 1%, 2%, 3% rates in place for way too long, and waited and waited and waited and waited. And then when they finally decided that it was too hot, they went from 0 to 1,000 miles an hour, right? In no time. But we all of a sudden have, 8%, 9% rates. And that just took things to a grind. And then now that things are not so bad, picking up a little bit, I don't want them to gas it too much. But then if that happens, you don't want them to brake too hard,
I agree. And I think a 0.5 point and then just let it settle. Let's see what happens. Give it 3 months. Give it 3 months. Then maybe if you need to do a little bit more. But yeah, I agree. They move too slow. And when they move too much.
Yeah, for sure. Yeah. Definitely.
That helps you understand. Do you have any other questions about HELOCs or HE loans versus refinances?
Yeah, well, I mean, you just said something that I don't think a lot of people understand. We talk about it a lot, that mortgage rates, right? Mortgage rates are tied to the 10-year treasury bond, right? So they go
10
up and
and
down
30
based
year. That's
on
correct.
10 and 30
Mhm.
year. And a home equity line of credit, not a HE loan, but a line of credit, is more like a credit card where it's tied to the prime rate, which I think right now is like 5.25.
That's
Uh,
about right.
right,
Yep.
plus a spread, whatever the bank wants to make in
Usually they're going to be between 2.5 and 3.5% spread on top of that.
okay. Yeah, so that goes up and down, and it goes up and down periodically every quarter, once a year.
Well,
What?
it goes up and down whenever the Fed decides to increase or lower the Fed rate because prime is going to be a direct indicator of the Fed rate. So it follows it pretty closely.
Got it. I guess I was lucky when I got my home equity line of credit then, because I got mine at a fixed rate and it doesn't change.
That's a great thing. It's a great thing. Well, you know what? I'm going to tell you why. First of all, you had equity in your property and you have excellent credit.
I do.
So if you are watching this, people that have great credit get better deals. It's just the fact, and they deserve it. So work on your credit. Make sure that you get your credit as high as you can. Listen, right now, a 725 credit score is not a great score anymore. It used to be.
It
Right
used
now,
to
you've got to be above 750, 760 to call yourself an A player.
be. Yeah, that's true. That's true.
And you'll save money. You'll get a better rate. If you buy a house and you need PMI, your PMI is going to be lower, might
Yep.
even be eliminated.
You
Your
also
car,
save money on insurance.
your car insurance, your homeowner's insurance,
Yep.
everything is cheaper when you have better credit.
Yeah,
So
for sure.
if you need help on that, seek professional help, call me, but don't go into a credit repair company. Most of them, I don't think, do the job and
Now they
they
don't.
just cost money. That is the Monday Mortgage Minute. I hope you got a lot out of that. If you have any questions for Tom or I lend in all 50 states, Tom can help you buy or sell a house in all 50 states. Our
Yep.
contact information is attached to this, and we appreciate you watching this.
Bruce,
Have a
make it
great
a great
day.
week.
You too.